I'm Jackie O'Neill, and in advance of the CAI 2022 panel, I'm going to talk a little bit about mobile money in India and Kenya. In terms of tech adoption, at least for the 80% of workers who don't work at a desk and a computer, both countries are mobile first and for many groups, mobile only. Despite the similarity, they're quite different settings when it comes to the penetration of mobile money services, which are the most pervasive digital financial services in this country. In India, adoption of DFS has been slow. It's accelerated in recent years because of strong government push, especially demonetization, as well as more recently the COVID pandemic. A major challenge for companies wanting to increase mobile money adoption and mobile payments is the limited infrastructure. For such systems to work, there has to be trust in the system at all levels. And that involves being able to not just make payments within the system, but also to take cash out. And typically the places where money goes in, the cities, are different to the places where money needs to be taken out, the villages, creating interesting cash flow challenges. This infrastructure was never developed in India, whereas it was in Kenya, where M-Pesa is king. In India, as in other countries, mobile payments have recently had an increasing adoption through the payment interfaces of apps such as Uber and Ola. The challenge in India was that whilst this is beneficial and easy for the customer who's making the payment and better for the platform who can then extract a percentage of the digital earnings, its benefits are asymmetrical, as the drivers might often prefer cash. Communities with the lowest income are typically still primarily cash-based. Once payments are made in app and the platform then controls when and how much is released to the driver, and the driver is likely to need to cash out to use this money. Whilst we found that if a small percentage of income was digital, it was actually beneficial for the driver. As this percentage increased, it became problematic, as drivers did not have the money for their daily living, things like petrol and food. Interestingly, even in Kenya, where M-Pesa is predominant and widely accepted, in more rural areas where incomes are lower, cash is still preferred. In this case, because of the fees of making M-Pesa transfers, which, while easy to write off if you're wealthy, become increasingly important as your income decreases. In this panel, I hope we're going to consider both the benefits and perils of digital payments and mobile money, especially on those with the most precarious incomes.